Welcome to Market Call. I'm Morella Fernandez. Shane Obata on the show today, portfolio manager, Middlefield Capital Corporation. He's going to take your questions today on global and technology stocks. Here's how to reach us. If you want to call toll free, 1-855-326-6266. You can email your questions as well. Market call at BNNBloomberg.ca. Shane, thanks for coming in. Let's talk about the big news for a moment, if you don't mind, that one of the U.S. courts has deemed Donald Trump overstepped with the tariffs. I'm wondering what kind of market reaction you've seen today.
Yeah, we kind of thought this might happen in terms of pushback against the tariffs. So we'll see where this goes. I think the overarching view really is, though, more uncertainty, which isn't great. So it's been a very tricky year, and I think it's probably going to continue to be that way.
Now, I was going to ask you about the uncertainty, because off that top headline, when you're like, okay, this sounds great, people are now going to sort of move forward, and they don't have to account for tariffs, except we know there will be an appeal by Washington. We know that it'll likely go all the way up to the Supreme Court. So do you see it as more of an extension of uncertainty than we were seeing before?
Well, so far it's been, you get one thing happening and then it's reversed, and then you get another thing happening and it's reversed. There's still stuff that needs to happen for more clarity. Unfortunately, in investing, you don't always get the full clarity that you want. Often you don't get it at all. So it's tricky going forward, thinking about, for example, the industry-specific tariffs that we still don't have clarity on, right? Like semiconductors and pharma, for example. So there's still a lot of things up in the air. So yes, the bottom line is it's uncertain. So I think that's how the market has treated it today, as initially a knee-jerk positive reaction, and then, okay, what does this mean? Yeah. What's next?
I was also wondering whether or not you think, and again, it depends what happens in the next 24 or 48 hours, whether some of the countries that are exporting to the U.S. might try to stockpile inventory like they did ahead of the tariffs being applied the first time, try to get ahead of the curve if the tariffs come off, and then sort of see what happens, after that.
I'm not sure how people are going to react. I would gather it might be the other way, which is to say people have been planning to deal with the tariffs, and now they're planning not to deal with them, and then maybe in 24 hours that it's back on in a different way. So
more paralysis is kind of what you're saying.
Yeah, definitely.
People don't know what to do, so they're not going to do anything.
Yeah, I'm glad I'm not managing a global business right now.
Yeah, absolutely. Okay.
For sure.
Shane, we'll leave that part of the conversation there. We're going to line up some phone calls. Shane Obata is with Middlefield Capital Corporation. He's taking your questions on global and technology stocks today. Here's how to reach us. We're back in a moment. Welcome back. Let's go to an email from Holly. She says, what are your thoughts on Western Digital, which does digital content solutions?
So Western Digital now, after the separation, which I'll get into in a second, is basically the hard drive disk business. So as a whole, pre-separation, it was different kinds of storage. So Western Digital, before the separation into Western Digital and SanDisk, was hard drive disks and then flash memory. So hard drive disks, conventional storage that you'd find in computers, and then flash memory would be like flash drives and whatnot, right? So over time, what's happened is that solid state drives have kind of taken away from hard drive disks in modern computers. So that's been a challenge for the storage companies, but AI, and I'm wondering if the caller is asking about this question as a potential AI play, has increased the need for mass capacity storage at the data center, and those are hard drive disks. So that is a tailwind for Western Digital. As I mentioned, it's only the hard drive disk business. But what I would say is we've tended to stay away from hardware in general over time. So I'm neither going to recommend nor say not to buy this, but we just think, especially in the context of AI, there's much cleaner stories with less cyclicality that are more well differentiated. So we don't have any exposure to storage directly right now.
Got it. Okay, let's go to the phone lines. Ryan's on the line from Saskatoon today. Hi, Ryan.
Oh, hi. My question's on Salesforce. Would you be buying at today's price with the recent acquisition and earnings, and just your future outlook for this company? Thanks.
Okay, Salesforce bought Informatica and also reported earnings just yesterday. What's your take on Salesforce and the buy?
Salesforce, we've kind of been on the fence on this name for a little while. It's back in the day, you'd view it as a high growth software company, and it's now become a lower growth software company, which of course is going to happen as you get bigger. And so I think the recent deal is fine, but my concern with this was, if you remember when all the activists, I think there were 5 or 6 of them in this name all at one time, they looked at the business, they said, oh, there's a lot of profitability that we can eke out of this as we trim the fat and whatnot. And the company said no more M&A, and now it's back to M&A. So that's sort of confusing to me in terms of messaging. And then the other thing is I'm waiting for more durability in the software AI story. It's slowly coming together in Salesforce's case with Agentforce and ServiceNow and Adobe and the others. They have their own offerings, but they're small right now. So I'm kind of wait and see with Salesforce. I don't think there's anything necessarily wrong with it, but I just think we can find better ideas right now.
Got it. Okay. Hope that helps, Ryan. Let's move on to Terry calling from Vernon, BC today. Hi, Terry.
Oh, good morning, Marella and Shane. My question is on BYD and NIO. I just wanted to know what you thought of the Chinese EV space, and it's a good time to get in right now.
So BYD is doing well, I think, more so in Europe because Tesla's taken sort of a bit of a beat down in Europe. But what's your look on BYD?
So I'll start off by saying we don't have any auto exposure right now, but I can provide some interesting insights. At least I think they're interesting. So I spoke with a well-regarded analyst, a sell-side analyst, maybe more than a year ago, on the topic of Chinese EVs, and at the time, he basically said the game is over. They've won. And it's interesting when you think about manufacturing. When you want to do something correctly and be the best at it and get the lowest costs, et cetera, of course, there's subsidies involved in select Chinese industries, but you want to have your manufacturing, your design, your components, ideally everything all together geographically. That makes it easier, right? So BYD is offering low-cost solutions, and it's going to be tricky for the world going forward because I think consumers would eat them up if they have the chance. But what's that going to do to domestic industries, right? Okay. What's that going to do to the European auto sector? What's that going to do to the American auto sector? So I think they're doing a great job. I don't have a buy or sell recommendation on the name right now, but I will say that that's kind of we're growing confident in the idea that they're leading in electric vehicles right now.
I just wanted to say we had the wrong graph up a moment ago. That wasn't BYD, it was Boyd Group. So just a note for the viewers. You mentioned that you don't know what it'll do to other markets. And there are levies on imports in North America to the Chinese EVs. And I'm wondering whether you think eventually that could get resolved and we'll see more here, or do you think that'll just stay and that'll limit the growth of BYD here?
I think what would need to happen to make the relationship better is something like the reverse of what's happened in China, where you have foreign companies going into China and creating jobs for Chinese people. And so it probably has to be the reverse situation. But again, it's a tricky conundrum because of the pricing differences.
If they opened up here in North America somewhere, there would probably be more of a chance that they'd be embraced. Would they ever do something like that?
I think if they had the choice, of course, they would want to do it.
Okay.
But it's one of those things, right? And this is something we've been thinking a lot about in regard to tariffs. What price premium do you pay for a nationalism, for example, right? It's like ultimately consumers in most cases want the best value. And so if you give them the best value, they're probably going to take it. So, yeah.
Got it. Okay, let's try and get to one more phone call before a break. Michelle's on the line from Vancouver. Hi, Michelle.
Hi, Morella. I would like to change professional opinion about Lam Research. I've been holding it, but it hasn't moved very much. Is it a hold for the long term? And what are your thoughts on it? Thank you.
Okay, thanks for the question. Lam Research.
Thanks. So within the semiconductor space, we would have a tendency, we don't own Lam Research, so we've had a tendency really to stick with the select few names that are best exposed to AI, and that doesn't include the equipment makers. The equipment makers, I think, are in a tricky situation. So, for example, we used to own ASML, which I still think is a great company, but we got out of that a while back now. And part of the reason was that, as you continually see in the headlines now, the US is trying to clamp down on China's access to everything related to semiconductors, so they can't produce leading edge chips. And China's part of China's response to that was to buy as much lagging edge, just not the most advanced, but larger chips, equipment for that stuff. And so I just feel like that provides maybe an overhang going forward, given that there was so much rush ordering for that lagged equipment. So yeah, we've tended to kind of stay away from equipment. I'll talk about another one that we like a lot more in my past picks today.
Got it. Okay,
Yeah.
We're going to take a quick break. We're going to line up more phone calls for Shane Obata. He's with Middlefield Capital Corporation. He's taking your questions today on global and technology stocks. Back in a moment. Welcome back. Let's go to an email from Mary. She says, is this a good time to buy Palantir? Mary from Victoria asking that question. Let's talk about Palantir.
Palantir. Okay, where do we start with this one? So let's just start with what I think Palantir does. Okay, so Palantir, I had one of my most tech-savvy friends describe Palantir to me as consulting with AI. So I think that's maybe overly simplistic, but I think that's generally in the right idea. They're going in and they're providing solutions. They're oftentimes taking data from disparate, multiple different sources, pulling it together and allowing for analytics for companies to do things in military applications, logistics, operations, et cetera. And so one thing I'll say is they have cool YouTube videos. If you go on their YouTube channel, you can see some interesting use cases. So we don't own the stock, and is it a good time to buy Palantir? I don't know. But what I will tell you is that you need to know, if you're involved in this stock, that there is no fundamental grounding for this stock whatsoever.
What do you mean by that?
It trades, it's a story stock, it's a cult stock.
Got it.
There's no valuation parameters that you can use to make sense of what you're paying for this stock. It's astronomically expensive, is what I'm saying.
And is your friend a fan of it? Does he like Palantir?
I don't think so.
Okay.
At least not the price that you'd have to pay right now. So point being, it's a story stock. It's worked out. I'm not saying it's not going to work out, but it's not grounded in fundamental valuation. So that's something that you need to know if you're involved in this name.
So it's a bit of a buyer beware.
For sure. It's like a meme stock, pretty much. Yeah.
Okay, let's go back to the phone lines. And Sal's on the line from Toronto. Hi, Sal.
Hi there. Yeah, my question on ServiceNow. I was interested to know, it's had quite a bit of a run-up over the last month, and I was wondering, is there still good momentum into the next earnings and into the summer, or if you think it's a time for waiting for a pullback? Thanks so much.
Okay, so again, a software company.
Yeah.
Can you describe a little bit more about what they do?
Yeah, it's lots of different things, but they started off in like IT service management. So for example, they would help an IT organization within a larger organization get someone set up, a new employee set up, or they would help with procurement of electronics and things of that nature. And they've moved into other adjacencies, so it's now much more than that. But I would start off by saying this is one of this stock has shown some of the most durable revenue growth in the entire market. So this is one that we definitely like more than Salesforce. It's more expensive, but I think that they deserve kind of a valuation premium because they execute so well and the CEO is great and whatnot. So I think this is a good hold. We've held it for many years and we don't see any reason to change that. The same question, though, goes that we talked about Salesforce earlier, is we need to see traction around AI with this name over time for for the story to continue working, I think is fair to say. But it's a great company, so I would stick with it for the long term.
Got it. Okay, let's go back to the phone lines. Roger is on the line from Edmonton with a question. Hi, Roger.
Hello, Marilla. Hello, Shane. It's I want to ask about Celestica. Your thoughts. I'll hang up and let you discuss.
Okay, thank you for the question. Celestica.
It's been a darling stock. Had a nice recovery, as you can see there. When I think about Celestica, when I first looked at it, it reminded me of when I was looking at Dell and HP as potential AI adjacent stocks or AI beneficiaries. So let me explain what I mean. There was a long period of time where Dell and HP would trade at a low multiple because they're commoditized, they make PCs and printers and whatnot, but it's not that differentiated, even though they have good brands. And so when the people started to attach an AI multiple and talk about how they should trade it closer to a market multiple and whatever, I will get to Celestica in a second. I just think it's a good way to look at this. So the point that I'm getting at is that within a Dell computer, all of the key components come from other people. They are assembling and putting this together for you to use. But that to me is difficult in terms of pricing power and in terms of technological differentiation if you're getting all your parts from other people, right? So I have similar questions about Celestica, right? They're selling server systems and networking gear into mostly the hyperscaler clients, and they've done a great job, but I'm not sure as if they're too much more differentiated than really an assembly company. And they're positioning themselves as such, and because they have engineering expertise and they help with the design of the systems and whatnot, and I think that's probably true, but I'm not, again, I just think there's cleaner ways to play AI.
Do you worry about the value of them over the longer period?
I worry about the fact that electronic manufacturing companies generally don't have great operating margins. And so eventually, if there is a digestion phase, as the market was kind of preempting earlier in the year, it will be challenging for them, for sure. So if you get into these periods where something is viewed as it's tied to this AI theme and it's viewed as capturing this and it's going to lead to multiple expansion, well, as we saw with the post-DeepSeek period, oftentimes it's the derivative plays, so not just NVIDIA and Broadcom, et cetera, that see massive multiple compression. So I do think that's a risk over the long term.
Got it. Okay, let's go to a quick email from Ron before we take a break. Ron says, would you be buying Visa at these levels? Visa, of course, an expensive stock, seems to do well. Do you worry about it losing any value with payment systems sort of gaining traction?
Every time I've trimmed the stock has been a mistake. So let me start by saying that.
Okay.
This is a great example of the power of network effects, which is something that we would view as providing competitive advantage. So what that means is that we all have a Visa card because all the merchants that we go to accept Visa, and they all have Visa integration because we all have Visa cards. So that's not going to change. And I think the story around going from cash to digital, that's played out largely in developed markets like Canada, right? Like penetration is very high, but even still, they still deliver great or decent sales growth and low double-digit plus earnings growth. And I don't think there's any reason for this to imminently change. So the business that most people know this for, the conventional business, is dependent on number of transactions and the value of transactions, and they get paid for authorizing transactions and whatnot. Now there's a new value-added services component to this business, which is growing multiples faster than the core business, which is lifting the whole group's growth rate. And that's an interesting thing. It's really about security and analytics and other things, loyalty insights that they can provide to their clients. So I think that's the key growth driver right now. But there's no reason to abandon this stock, probably forever, really.
Forever. Okay.
Forever, yeah.
We are going to take a quick break. We will come back and have a look at Shane's past picks. Back in a moment. Back. Time now to go through Shane's past picks. This was from April 4th of 2024, so over a year ago. At the time, he picked Alphabet, parent company, of course, of Google. It was $150.53 American. Now it's moved up to $171.75, a 14% upside return and a total return of 15%. Do you still like Alphabet? And I ask because the headwinds, I think, are stronger now than they were a year ago.
I have mixed feelings. Okay. I'm going to rant a bit, so please stop me.
Rant away.
Years ago, we thought, and still kind of think, that Google has all the pieces to win AI, quote unquote.
Okay.
They have lots of platforms. They have good data. It's really it's a engineering business, right? It's research people. So the difficulty, though, is that may not matter, because they need to figure out where they're going to fit in AI. So let me explain. ChatGPT has become synonymous with AI. And I think you could make the argument they've won the consumer subscription game already, right? So that's going to be challenging for Google to take from them there. In enterprise solutions, I don't see anyone displacing Microsoft. I've tried Copilot. The last time I tried it was still bad, but it doesn't matter because we're all captive to Microsoft through the Office solutions. So as their AI inevitably improves over time, they're going to win enterprise AI, right? So I'm trying to figure out, where does Google fit into all of this? And so I'm a big Google fan, so this is just my frustration. Like, I'm the only person I know with a Pixel phone, for example. So okay. I really am a Google fan.
You are the only person, yes.
But I'm the only person in Canada. But it's like I said, it's just trying to see how they fit into the mix. And then some of the headwinds that you're alluding to, like, for example, search is the crown jewel, and it's such a big part of the overall business. Are they going to have to cannibalize themselves to win in AI? The business is already changing with the AI overviews, and I won't get into the specifics, but that's changing. And so what's going to happen there? That's unclear. But it is clear, and the irony of the regulatory cases against them is competition has never been higher for search. I think the term Googling, which to me still means go Google something, Google it. I don't know if young people say that. They're searching. They don't care where they're searching. They're searching on ChatGPT. They're searching on Google. They're searching on Instagram. They're searching on Amazon. So there's a lot of competition here. I think they can still deliver decent results, but I think the multiple at the very least is going to be capped on this, because these concerns are not going to go away.
Would you then hold if you're holding, or would you put money in if you're thinking of putting money in?
I think I'm comfortable holding right now. We still own it. Like I said, it's cheap at the surface level, but there are reasons that it's cheap, right? Okay. So I do think maybe one day it can trade at a much higher valuation, but there's a lot of things to get through here. Let me finish by saying they're doing a great job in the actual AI that they're delivering to people. Like Gemini, for example, is excellent. But it doesn't matter if they can't find the way to monetize it. Is it going to be ads in Gemini later? We'll see. Is it going to be subscriptions? We'll see.
Got it. Okay, let's get to your next past pick from April of last year. Micron at the time was $124.09 American, now down to $96.40, 22% return drop, and total return drop of the same. What happened with Micron over the last year? I'm
done with memory stocks. We talked about storage stocks earlier.
Same deal with memory stocks.
It's similar in that it's a strange thing. Okay, so you have an industry that only has a few players that are completely dominant, Micron being one, SK Hynix being another, Samsung being another. And yet, you still have crazy cyclicality, and it's hard to be differentiated again, right? So when I pitched this stock, it was probably around the HBM story, which is still playing out, high bandwidth memory needed for AI applications. That's still going to work, but I just, again, have tried to simplify my exposures to AI and pick clear-cut winners as opposed to derivatives.
Got it. Let's get to your next last pick from April last year, Taiwan Semiconductor on the New York Stock Exchange, 139.96. American, they've done really well, 196.66 today, up 40% return, up 42% total return, and they've got a lot of forward steam as well.
This is a great example, and I'm not just saying it because it's up and Micron's down, but this is a great example of a direct AI beneficiary. There's no, that's it. I mean, so let me start by explaining what Taiwan Semiconductor does. They are the world's leading foundry business. They make all the chips for basically everyone. They make NVIDIA's chips, they make Broadcom's chips, they make Apple's chips. The list goes on and on. They're completely dominant. And as we know with Intel's struggles and Samsung's struggles, they've kind of just gotten to a size and scale and expertise where now they're building new fabs in the States and elsewhere that costs $25, $30+ billion. And in a strange way, even though they're putting out so much money to do that, it's extending their competitive advantage because no one else can compete with them at this technology. So this is one of the few AI stocks that you can actually get still for inexpensive valuations. And I think largely that's around concerns around Taiwan invasion risk. I hate to say it, but it's not going away. I don't think that's a near-term concern. I will say that we do feel as though having all that technological power concentrated in such a small geography, of course, that's concerning, right?
But they are trying, as you said, to expand that.
That's right. So they had announced investments in the States, and then to appease Trump more, the full amount of the investment is $165 billion. And I think what they did was smart in the sense that they placated him by offering additional investment, but not necessarily being too tight around the timelines.
Absolutely, yeah.
And so one thing to think about in the context of technology like this, and this is where I don't really understand, you have to let market forces do their thing. And so what do I mean by that? If Taiwan Semi was to magically overnight become 50% production in the States, that's just going to lower the margins and be bad for shareholders. That's the simple answer, right? And they'll figure out ways to make things better over time, but that's what it is. There's an element of labor arbitrage and technological expertise that can't be replicated and higher construction costs. The list goes on and on. So I think it's good to see companies with global operations like this being measured about their expansion plans, because you can't just operate somewhere because someone wants you to.
Yeah.
There has to be a business case for it.
Yeah.
Right?
Even if Donald Trump demands it.
That's right. And I'll just finish off by saying they have very strong demand for their U.S. production, but even so, it will come at a higher cost, and probably a higher cost for their customers too.
Got it. All right. Shane Obata here to answer your questions today on technology stocks. We're back in a moment. Stay tuned. Welcome back to Market Call. Let's go to the phone lines. Richard's on the line today from Calgary. Hi, Richard.
Hi, good day to you both. I'm just wondering what Shane's thoughts are on Uber. I know he's liked it in the past, and does he still like it? Thank you.
Okay, we haven't talked about Uber in a while. What do you see for forward-looking growth for a company like Uber?
I think they can continue to deliver solid top-line growth. We don't own it right now, but I think you're going to get splitting the business in two. You basically have a company that's ride sharing already, And then the food delivery business is also good. So unfortunately, we've kind of been on the sidelines for this one. We're watching it. We do have some questions about it, but I think it's a good company.
Are you worried about robocabs?
Yes, that's what I'm worried about.
Okay.
So, yeah, like I said, the business has done well. The management team has done well transitioning this from a non-profitable stock that people were concerned about from that standpoint to something that's durable. And like I said, they have durable growth. But yeah, the autonomous vehicles thing is interesting, right? So there are people that will tell you Tesla's going to win this game. People will tell you that Uber's going to win this game. People will tell you that Waymo is going to win the game. I'm not sure how this all pans out, but Waymo seems to have some serious traction right now. So I think that's going to be an overhang for them because they don't have the car, they don't produce the car. So I'm trying to figure out what's the actual advantage. Of course, Uber has distribution and they have good software. But Tesla, for example, has, even despite that, kind of chosen to mostly go their own way. Now, the relationship between Uber and Waymo is strange in that Waymo is doing what I think is a smart thing and partnering in some areas and doing their own thing in other areas. And they're basically going to determine what the best model is for them going forward. So I do think the more success Waymo has, and potentially if Tesla has success, that could provide an overhang for this stock. But I do think it's a good company, and it's one that we'll continue to revisit, but we don't own it right now.
Got it. Okay, let's get to an email from Wally. He said, I'd appreciate an opinion on CrowdStrike and the U.S. security software sector at this time. CrowdStrike.
CrowdStrike is, in hindsight, we should probably buy this stock every time it goes down a lot. It's always expensive, but from our discussions, they're the best at what they do, which is endpoint security versus others who will do things like network security and whatnot. So I will say we think it's a great company. We have difficulty wrapping our heads around the valuation, but we've tended to stick with Palo Alto as our more reasonably priced and safer and slower growing company. But that being said, the overall security software space, I think, is very attractive. We've thought that for a long time, and we think there's going to be a continued focus on that. Okay. So with the rise of agents, for example, if they're scouring the internet and logging into different things on our behalf and whatnot, that would naturally creates more traffic, more potential attack surfaces, and then of course on the identity side, there's probably going to be needed some security needed there as well. So I think it's one of the most defensive parts of the software industry for sure.
Okay.
Yeah.
We are going to take a quick break. Shane Obata is of Middlefield Capital Corporation, taking your questions on global and technology stocks. More questions and answers coming up. Stay tuned. Welcome back. Let's go to Dave today. He's on the line from St. John's. Hi, Dave.
Hi there. Thanks for taking the call. And Shane, today there's really big volume again on D-Wave and IONQ as well as QUBT. So I was wondering, what's your take generally on the quantum computing space? Do you think it's safe to venture into it, and might you have a best pick? Thank you very much.
What is your like for quantum computing?
It's nascent. That's how I would start off.
Okay.
So with respect to the companies that you mentioned, we don't own any of them, and this is a technology that could have some promise, but right now it's not clear that there's commercial applications yet. And so I would lean more and just look into what companies like IBM and Google are saying about this. It seems to me like an end of the decade type of story. So I just think it's too early. But when big companies like Google are telling you there are no commercial applications at this point, I think it's better to wait, personally.
Okay.
So it's not that I'm not optimistic about what can happen. It's more just wait and see at this point.
Okay. Let's go back to the phone lines. And Frank's on the line today from Mississauga, Ontario. Hi, Frank.
Hi. Thanks for taking my call, Shane. Before I get to my question, if you allow me, I wanted to say to not give up on Google. people forget YouTube. Today, I do more searches and spend more time on YouTube than anything else. It is the world's best streaming platform, and it's free and gives you all the information you need. So yeah, I wanted to say that. My real question is on Amazon. What are your thoughts on Amazon? It's been stuck in this range. It's range bound, and it's also got a lot of pieces in the pie. Do you think this is a story that's going to evolve and get better over time, or it's maxed out as far as the valuation is concerned?
Okay, thanks for the question, Frank. So let's talk about Amazon, because everybody knows it as the online retail business, and some like it, some don't for different reasons. But I'm wondering the other side of the business, which does seem to be gaining traction, and is that where you think there's going to be superior growth?
Definitely, yes. That would be in the cloud computing division, in the advertising business, and but e-commerce is still overall in society underpenetrated, and it's been so long. It's still under 20% penetration. So there are nuances around that, right? Like, can someone figure out how to do grocery properly, for example? That's trickier. It's fresh items and whatnot. But I have for a long time viewed Amazon as a logistics business. They are the best at logistics. And that's why Prime is so awesome. And that's why we get some stuff same day, a lot of stuff next day now. So I think they've fully won that game. And then, as you mentioned, still a leading player in cloud computing. That should provide durable growth. And then the advertising business is great too. So I think the overall story for Amazon, for a long time, people complained about it for not being a profitable company. Now it actually has a PE multiple. Over time, they're going to continue to eke more profitability out. So I actually do like this as one of my favorite of the Magnificent Seven stocks right now. And then just since you pulled on my heartstrings with Google, I will say that I love YouTube. I am on it constantly, and I think YouTube Premium is the best value subscription out there. But will it matter if search starts to deteriorate a little bit?
Yeah, maybe not.
Unfortunately not.
Got it.
One more fun fact before we go on Google. YouTube as a whole, between the ads business and the subscription business, is bigger than Netflix.
Interesting.
Yeah.
All right, good to know. Okay, let's go back to Ralph on the phone line. He's calling from Victoria today. Hi, Ralph.
Hi there, Morella and Shane. My question's regarding Arista Networks. If I could have Shane's opinion and outlook on Arista Networks for the next 12 to 16 months. Thank you. I'll hang up and listen to the...
Okay, another cloud company here.
We've owned Arista in the past. We currently don't have a position. And as you'll know, if you've owned it, it's very volatile. So
why is it more volatile than some of these other comparables?
Well, it's first of all because it's generally expensive, and second of all because it grows at a pretty decent clip as well. So I would say networking coming into 2025, we were super optimistic about networking as a space. And Arista is going to provide networking solutions for AI. They do many other things, but that's why the story has hype around it. So the difficulty has been earlier in the year when we started hearing rumors about Microsoft slowing down and companies taking their time. I think that proved to be untrue in the sense that all of the major companies committed to continuing to spend on the AI build-out. But what I do think is true is that they're going to think more hardly about how they're going to configure their data centers and how much they need their data centers to talk to each other versus how much you want to invest in one data center within the data center. So I think for now we're kind of on the sidelines with networking, but Arista is one that we will revisit. But right now, it's kind of wait and see for us.
Got it. Okay, we are going to take a quick break. That's all the time we have for questions, but new top picks from Shane when we come back. Welcome back. Time now for new top picks from Shane Obata. His first one is Take-Two Interactive. Tell us why you like Take-Two. They're a gaming, I guess, company. Tell me more about the kinds of games they offer.
Yeah, video game publisher. So let me just start off with a quick preamble on why I like entertainment, which kind of pertains to two of the picks today. In periods of economic uncertainty, I think it becomes very clear how much value you can get from streaming. We talked about YouTube earlier, but that could be music too. And video games are another one where you can pay $80 and play something for 100 hours. So it's good value. So Take-Two is a video game publisher. Their crown jewel, which I want to focus on today, is Rockstar Games. So Rockstar Games has made epic games such as Grand Theft Auto, which is the focus of this, and then also Red Dead Redemption. But the key thing with Rockstar Games is there are AAA games in the market, very expensive, high production value games, but those aren't always 10 out of 10 games. These guys make AAA 10 out of 10 games almost every time. So we're about a year away from the release of GTA 6, which I think could be the biggest entertainment property ever. And we think that street expectations are a little bit too low on units. We think there's upside to how much they could price the game at. And we think the true upside might come from user-generated content, kind of borrowing from the Roblox model, as gaming companies are now making more money from in-game transactions and things of that nature. So I think that's where the industry is going. So we think Take-Two is going to deliver around 11.34 of EPS in fiscal year 27, which will capture GTA 6 launch. And so at a 30 multiple, that gives us a price target of 340. So that's substantial upside from here, probably around 50+%.
Got it. Okay, let's move to your next pick, which is Sony on the New York Stock Exchange. What do you like about Sony moving forward?
Sony is probably best known still for making TVs and whatnot. That's kind of where they were.
Yeah, ghetto blasters.
So they were born out of consumer electronics, but that's become a very small piece of the business and frankly, not a very attractive one. But I don't think they'll get rid of it because it's kind of their namesake and whatnot. Anyways, two key properties within this structure that I want to highlight are PlayStation and also music. So PlayStation will be another beneficiary actually of the release of GTA because they take a rake similar that you see to those that you see on the App Store and whatever. When a game is sold, they will take a percentage of it. So they should benefit from GTA 6 specifically. And then we also think that they're going to continue doing well with their online services, which they charge monthly fees for, and they have other good pieces, games that are developed by Sony themselves, very good games. So we really like the gaming side of the business, and then the other side of the business I would focus on is the music business. So Sony is the second largest of the big music companies after Universal. And so they own a lot of the music in the world, really, and they make money from recording and publishing. But if you think about the music industry, it was not in a great place when CDs were still around, and then we had digital kind of pirating issues and whatnot. Well, streaming really has saved the music industry, and Sony will be a continued beneficiary of that. So we think Sony can deliver 225 JPY of EPS in fiscal year 2027. So at a 21 multiple, that's 47.25, around over 20% upside from current prices. That's in yen.
Got it.
Yeah.
Let's get to your last pick before we're out of time, National Grid, which is utilities
yes,
out of the UK.
This would be the safest of the three for sure. So the largest UK utility by market cap, probably best known for the UK operations, but actually now pretty evenly split between UK and US operations.
Okay.
So the company has a capital plan of 60 billion GBP, which we think is achievable over the multi-year period. That's going to deliver, we think, 10% plus asset growth. And hopefully their earnings growth target range is 6 to 8%. We're hopeful that they can get to the higher end of that range over time. So there were some question marks around the ability to fund this massive massive investment plan, and the company raised some equity, and we think that now those concerns are kind of in the rearview mirror. So this is, as I mentioned, the safest of the three. We own all of these in our global dividend fund, so should provide high single digit, low double digit returns over the next year and a bit.
In about 30 seconds or less, just wondering how much of the operation in the U.S. do they have?
Yeah, it's probably about half of the business now. So they have U.S. regulated operations in New York and I'm forgetting the other one, but there's 2 states in the U.S. Massachusetts, I think, is the other one. And then in the UK, they have 2 businesses. One is transmission and one is distribution. So it's a little bit of diversification there, too.
Which is always good. All right, yeah. Shane, we got to leave it there. Shane Obata, thanks for coming in. Appreciate your time in this. We'll see you next time.
Thank you.
And thanks for joining us here on Market Call. We'll see you again tomorrow. A quick look at the markets as we head to a break.